Good morning, everybody. Thank you for being here with us for our monthly update on the Hedge Invest Newman Credit Fund. The month of March was quite turbulent and volatile for us. We managed to capture some of the volatility and capitalize on it. Unfortunately, the biggest drag in terms of performance has been our directional short bias on government bonds, especially in the core area of Germany and France. Both countries actually performed very strongly, one of the strongest months we've seen in the last few years. And that created losses for the book, both on the macro side and on the hedges that we built around our exposure in credit. The vision remains the same, although we're trying to be very disciplined and very opportunistic in terms of trading, and so we minimize some of the losses compared to the directionality of the book. Our view remains untouched. We do expect the ECB to exit their quantitative easing. We do expect the ECB to radically change the management team, with the vice chairman, the chairman definitely leaning towards a more orthodox and hawkish stance. And we also do think there's going to be an acceleration of corporate governance at all levels of European institutions that would then undermine any desire of the ECB Council to supplement the lack of political initiative from the political institution of the Eurozone. Because of that, our view on rates, on bonds, and across that all the way to periphery remains very, very negative. We think it's going to be the trade, or one of the most interesting trades of 2018. And so we remain with a short bias on government bonds. In particular, we do think that Germany and France are probably the ones that will suffer the most, while periphery will be probably a little bit more mixed, with a decent interest for Greece. Away from that, our view remains the same. On emerging market, we're quite negative, especially in credit, specifically for what concerns Turkey. We think is the weakest link, if you want, from a macroeconomic point of view, geopolitical point of view. Remains a distant short for our fund. It performed well over the last few weeks. We still think there's massive upside there, and remains a core position for us. Away from that, the corporate sector has been quite a negative drag for us during the month of March. Most of the position we have, as you know, are market neutral or capital structure hedged, with a decent emphasis on the short bias on the credit side, and a small position long on equity to compensate the short. We typically build those around events, around the merger and acquisitions. We had position on Abertis, Monsanto Bayer, and Qualcomm, and XPI. For what concerns the capital structure trades, unfortunately, the equity suffer from the interventionist stance of the Trump administration, which we think is predominantly for political consumption, and so eventually will actually fade out, allowing the trades to be consumed as planned initially. But unfortunately, the leg that hurt the most was the short in credit, Qualcomm bonds, Bayer shorts. All these positions which were short credit actually moved against us, and we suffer because of it. We think part of the outperformance of the credit shorts was because the strong performance in bond and related government bonds. We do think that sort of outperformance, actually widening of the basis between our equity long and much bigger credit short, is actually temporary in nature, and should actually come back quite decently over the next few weeks, months, hopefully within the month of April, actually. For what concerns the bank side, we remain very positive on the fundamentals. We like them. Most of the names we are positioned have a decent set of idiosyncratic drivers, positive drivers. Fundamentals are improving all across for banks, and I think the technicals have definitely cleared up quite a bit. We suffer on that sector quite a bit because of the short bias on rates. We tend to have all this position hedged, and we're trying to be very light on interest rate sensitive security, especially AT1. Obviously, there was a negative for us as well. So pretty much we had most of the strategy going against us. The view remains the same. We feel very, very strongly about our position on rates, especially Germany and France as a core short. We do think that will happen, and it will happen relatively soon with a big acceleration after the summer. On the corporate side, we still believe in the technological winter. We think that will trigger a wave of defensive M&A transactions, which will be bad eventually for the fundamentals of the company. And so that's why we want to be very short credit, especially investment grade names like Vodafone, Deutsche Telekom, on Bayer, Qualcomm. All those investment grade names we think are overvalued, and they are in for a massive repricing within the next quarters. And at the same time, on the bank side, we still view it as an unloved sector, although we be very mindful on the interest rate sensitivity. But we do like a lot of the idiosyncratic stories, whether are Vivat or in Holland, or is Unicaja and Liberbank in Spain, or even Carige and Paschi in Italy. So we really very much like the portfolio. We think there's a massive upside from here, and we like to be short the negative drive that we see on the macro picture. With this, I thank you. Thank you very much for your time, for your trust, and for staying with us. And I hope to see you soon next month for the new update. Thank you very much.